Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 22nd of November. I'm Daniel Lam, your host for the podcast. I would like to expand upon a key point in the podcast yesterday, that hedge funds had been, and very likely continuing to build out on their long-short strategy, and in this case, shorting other S&P 500 stocks and long the mega-cap growth companies. So yesterday, we concentrated upon the long side of this equation. Today, we'll take a look at the short side of things. In particular, let's concentrate upon oil and the energy stocks, given the sharp swing in sentiment this year. Now, oil prices have weakened despite the supply cuts and the geopolitical volatility from the Middle East. It seems that the market is concentrating upon the downshift in global oil demand. How do we know that? Well, crude prices and the Harpex Container Freight Index goes hand in hand. So what is this Harpex Container Freight Index? It is the price to ship goods in containers. Now, falling container freight rates indicate that demand for goods shipping is declining. Hence, it is a signal of weakening global demand. And it may take a major escalation in the Middle East in order to produce a more meaningful spike in oil prices. Technically, crude oil is on quite a strong downtrend, as indicated by ADX and MACD. The supply side cut led to rising prices in the third quarter this year, and the Israel-Hamas conflict sent prices back to challenge the highs this year in October. However, it failed to break, and it is now showing the bearish lower lows and lower highs price pattern. Global energy stocks have pulled back sharply by almost 10% over the past 4 weeks on the back of the oil price weakness. We believe as long as the macro trend is likely to continue, investors' preference is still likely to be in the growth / technology-related stocks, especially those in the US. With economic data showing some mild signs of weakness, investors are likely to be seeking out high-quality growth stocks with strong pricing power for their services. This bodes well for our sector preference in the US, in the growth-heavy technology and communication services sectors. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.